Hi, I'm Jessica Amir for the Finance News Network. Today I'm at Ausbil with Portfolio Manager Tim Humphreys and Co-Portfolio Manager Jonathan Reyes. Gentlemen, welcome to the network and thanks for having us.
Thank you, it's a pleasure.
Yep.
So first up, you look after the Global Essential Infrastructure Fund. Just give us an introduction to the fund.
Yeah, the aim of the fund is to provide well-diversified exposure to the best value essential infrastructure companies around the world, but predominantly in the developed markets. Essential infrastructure is an Ausbil definition, and it's really focusing on those companies that are essential for the functioning of a modern society. And what this means is that these companies have a very nice blend of defensive characteristics, but also opportunities to grow. And what this means for the fund is the fund has a very nice blend of growth and income.
And Tim, in Australia here we're seeing record amounts invested into infrastructure. If you wouldn't mind telling us what it's like overseas, what are the themes that are taking place, where's the money coming from, and what's really fueling the growth?
In North America, for example, a lot of the local gas distribution companies have networks of pipelines that are 60 to 70 years old, cast iron or steel, they leak, they're not very good for safety. And the companies need to replace these with more modern high-density polyethylene pipelines. But this is going to take 20 odd years, and that provides a fantastic opportunity for long-term investors to benefit from. On the environmental side, we see for the first time around the world that renewable energy such as wind and solar is now cheaper than traditional generation such as coal or gas for the very first time. And what we're seeing is that utilities are retiring their old and dirty coal fleet and replacing them with more renewable energy. And that's a fantastic opportunity for investors. And we're also seeing, particularly in the UK for example, water pipelines and water networks where the water leaks up to 20% before it even gets to the home. And the regulator is saying you need to invest into these pipeline systems in order to reduce the leaks, and that provides investment opportunities for investors such as ourselves to benefit from over the very long term.
Thanks, Tim. Now over to you, Jonathan. What's the fund aiming to achieve?
The objective of the fund is to deliver returns that are above OECD G7 inflation plus 5.5% per annum, and that's historically been around 8%, 8.5% on a per annum basis, and we think that the asset class overall is well suited to deliver those type of return expectations.
And earlier Tim mentioned some of the growth areas around the globe, but can you tell us about your sector exposure as well as your largest positions?
Something like an Atlas Arteria in Australia really does fit nicely into what we're trying to achieve. So from a top-down perspective, we have a view of lower for longer interest rates. We think that base rates are going to maintain globally lower versus consensus. And where we want to be exposed is stuff that's long duration, so Atlas Arteria fits that component. Sector-wise, again, transportation looks inexpensive to us. Enbridge in Canada would be another one. The energy sector overall looks attractive, and Enbridge particularly for the quality of the company. Enbridge historically has never been this highly discounted in the market, so we think it's a unique opportunity to buy. And then maybe something that's not as linear in the process, but next era energy, as Tim was talking through, one of the big thematics of infrastructure around renewables. So next era is kind of split between a regulated utility base and a renewable portfolio, so the world's largest wind producer. And for us, it's underappreciated portfolio.
Now moving to the overall performance of the fund, you've done quite well, so tell us about that.
Really has about delivering asymmetric returns, so being able to deliver better capture ratios, which we think is defined as talking about when the market goes up, being able to participate, and when the market falls, not falling as much. And for us, essential infrastructure historically has run close to 90% of upside capture, but only 50% of the downside. So since inception from December last year to 30 June 2019, the fund's delivered 21% net of fees, which is something we're very proud of, and that's about 17% above benchmark for the portfolio. So very happy with the start to the fund.
And just lastly, before we let you go, what's your outlook for the second half of this year?
Yeah, certainly around the world we're seeing infrastructure failing, we're seeing bridge collapses around the world, and we're seeing infrastructure that needs to be upgraded. So certainly the background for investing in infrastructure is not going away anytime soon, and that's very positive. We're also seeing the economic cycle and interest rate cycle being lower for longer, which is very supportive for infrastructure valuations. Within our portfolio, we're seeing the expected returns comfortably ahead of what our long-term objectives are.
Tim Humphreys, Jonathan Reyes, thank you so much for the introduction to the fund.
Thank you.
Thank you.